Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 430. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
You probably didn't even know there was a favorite podcast about life insurance.
You didn't, but now you do. And you are better off for it. So welcome.
That's right. Well, hopefully everyone got through the holiday without, or I should say with, all 10 fingers still intact.
We give it 2 thumbs up if we still can. And if not, we recorded this podcast, but there was a serious discussion about whether or not we do this. And I had suggested, well, if anybody's sitting in the hospital recovering from a hand injury, they'll have something to listen to.
That's right. And we're
Unfortunately, we chose the Modified Endowment Contract to be the subject of today. So
they're spilling the beans. I was going to try to build it up a little more before we told them. Well,
but hey,
I mean, look, in our ongoing search for things that people are interested in, the internet gods tell us that modified endowment contracts are very, very popular. So
they do.
I'm dubious, but here we are.
We're going to give it a try.
Yeah.
We're going to give it a try. It's not like it's the 11th time we've talked about it or anything, but
well, it is this boogeyman out there.
It is indeed.
And I'm guessing that's why people are interested in it, because it's something they hear and it's a weird term and no one knows what it means. They just know it's bad and they don't want one.
And they're quite afraid of it.
Yeah, exactly.
Yeah.
We get questions about it quite a bit, actually.
Yeah, we do. We do. So the questions that often come up are really focused on the fact that either somebody bought cash value life insurance and they're worried that they may create a modified endowment contract.
Yep.
Or they're thinking about buying a policy and they're not sure how to figure out if they're doing the right thing. And they're afraid that this might become a modified endowment contract because they read an article somewhere that said that that's something you got to watch out for. And they don't really know the mechanics of how that all works. And they don't really know how to look at what they're considering and figure out, well, will I or won't I have a problem?
Mm-hmm.
So we're going to help you do all of that today.
Yay.
Figure all that out by the end of this podcast.
Big promises there, sir.
Okay. We make big promises and we deliver on some of them.
That's right.
Should we start with some background? Like why?
Give us a history lesson.
Why this exists. So, we have universal life insurance to thank for all this.
Well, that's there again, we're just whacking UL on the head.
That's what the ardent whole life people have to say.
Yeah.
There's some truth to this. So, if we think about this in the context of what was going on, I was going to say a few, but that's not. Hey, haha, you're getting old, Brandon. Several decades ago, we go back to like the 70s, 80s timeframe.
Yep.
And we've got significantly higher interest rates than we have today, and we also have much higher marginal income tax rates than we have today.
Yes.
So there's kind of this perfect storm a-brewing when it comes to abusing or manipulating life insurance as a way to find yourself a tax shelter. So life insurance, from basically its inception, enjoyed a number of really fantastic tax attributes. It could grow cash value tax deferred. You could even distribute it tax free. And of course, the death benefit also did not have an income tax liability to it. So there were a number of things that you could do with respect to putting money in life insurance and basically ensuring that there would not be any additional taxes collected on those dollars, even as they grew.
Right.
So given this, there's obviously a desire, especially if you're higher income, to get as much cash into life insurance as possible. But that was a little tricky until universal life insurance came about and said, you can just put as much money as you want to in it.
Yeah.
And that's literally what universal life insurance did. And that was, believe it or not, earth-shattering at the time.
Yep.
So what ensued was a number of people buying very small universal life insurance policies, putting as much money as they could possibly get together into the policy because there was nothing in their way of doing that. And having what was effectively a tax shelter after that.
Yeah, I mean, think about some of the most egregious examples. I mean, you could have, there probably were more egregious, but you could do stuff like put $1 million in a policy and have $1,000 death benefit.
Yep, you could.
And the IRS got to looking at that.
Today, that sounds mind-boggling. All the younger agents are like, "What? Yes, this was a possibility at one time." So, like you said, Congress caught wind of this and said, "No." So
Congress said, we've already done it with all of our money, so now
it's time to stop that.
Now we're going to not let anyone else do it.
Right. Thus began a legislative process throughout the 80s that brought in a couple of different things. One was the establishment of what was and what was not life insurance based on how much money was going into it, but then additional restrictions that came about in the later part of the 80s that specifically established this kind of halfway point. So initially we had it's life insurance or it's simply not life insurance.
Right.
It's not even an insurance contract anymore, effectively. And then we got this halfway point that said, all right, fine. It's still a life insurance contract, but moving forward, it is a modified endowment contract.
Right.
And if that happens, there are a number of tax features that change with respect to this contract. We no longer have the ability to distribute our our basis first. So the FIFO distribution, first in, first out, that goes away. And if you distribute money from the policy, you have to take the gain first if there is any.
Yes.
Second, loans will no longer have any significance as far as differentiation from distributions versus withdrawals.
Right.
So whether you withdraw or you take a loan, it's still a distribution viewed as the same, and it's LIFO if there's gain.
Right. Right.
Which also means that any interest that accumulates on the loan will be looked at as a distribution if there's gain.
Yeah. So there's no reason to take a loan, in other words.
Correct. And lastly, if it is a modified endowment contract, it is still eligible for 1035 exchange treatment, but it cannot be transferred into a life insurance policy. It moves into another modified endowment contract, which means if it's a life insurance policy that would not normally violate the test, it will because the transfer is coming from a modified endowment contract.
Right. In other words, you can't recharacterize and get away from the change that's occurred.
No, you cannot. So those are all the things that are the consequences of becoming a modified endowment contract, which leads us to a very good question most people have at this point, which is, well, how does that happen?
How does a policy become a modified endowment contract?
Correct.
Yeah.
Which is the basis of the concern pretty much all the time.
Right.
The really simple answer is too much money is paid into the policy.
Right.
The legislation,
but it's not. I want to take a time out.
Yep.
It's not that. Just go back to our early example of $1 million premium. It's not too much money. It's too much money relative to the death benefit.
Yes, correct. That is correct.
In other words, you might be able to dump in $1 million all at once if you got a $5 million death benefit.
Yes.
And have no problem with creating modified endowment contract.
That is correct.
But you're not going to be able to put $1 million into a policy that has a $100,000 death benefit and not create a modified endowment contract.
Yep. That's a very good point, because I think people do get confused about what the limit is and they try to apply it universally. That's not the way it works. It is relative to the death benefit of the policy.
Right.
So the way oversimplification of everything is the maximum amount of premium that can be paid to a life insurance policy and not become a modified endowment contract is the amount of premium that would be necessary to create a 7-pay policy.
Mm-hmm.
But
meaning a paid up policy.
Correct. A paid up policy after 7 payments.
Right.
That is effectively the limitation that you have to stay underneath in order to maintain life insurance status.
Right.
If you go above that, then you will have violated the test and you will have a modified endowment contract on your hands.
Which is sort of an interesting concept when you think about if you understand how universal life insurance works, and there is no such thing as a paid up contract.
Mm-hmm.
Yes, the test exists still. So.
Yes, it does. It does exist.
And it works
now,
a little different than whole life insurance. I shouldn't.
It can. Yes, you are correct. So there's a couple different ways to argue that point. One is, yes, technically it's never paid up, but two, there's always the ability to sort of figure out what the relative amount would be needed to make that happen given the death benefit and expense structure. But you also hinted at something else that is important, deep in the weeds, but that's what we do. And that's the fact that the way the modified endowment contract unfolds as a limitation does differ for universal life insurance contracts that qualify as life insurance under the guideline premium test.
Right.
And everybody who's new to insurance just said, I'm done with this. This is... so that's not really the core of what we want to talk about today, so we won't go too far down that road. Just understand that universal life insurance does have some additional consequences, but also contingencies or relaxed rules-ish to accept a certain amount of money that would never really work out on a whole life insurance policy.
Right.
Because of the way that one of the possible ways universal life insurance gets designated as life insurance does give some flexibility for modified endowment contract calculations. Now, I want to step back just a second and talk about this whole 7-pay amount, because two things happen, or two questions come up. And one is, well, if it's the premium that's needed to make it paid up in 7 years, and I basically pay up to that amount less a penny or whatever nominal amount I want to use as my example. So if it's $50,000 is the amount that would be necessary for paid up in 7 years, I want to pay $49,999. And if I do that for 7 years and I get to year 8, does this mean I can now put $50,000 or $49,000 or whatever it is into the policy because we're beyond the 7-year period and it doesn't matter anymore? Or does this mean I can put no more money in there, period?
Right.
And the answer to both questions is no. And yes. Because things change over time when it comes to the construct of policies that sets you up in a situation where what would be necessary to make the policy paid up 7 years from now at inception is not necessarily going to be the same as what would be necessary to make the policy paid up in 7 years from now.
Right.
Or even 5 years from now, or even a year from now. Because, for example, many forms of cash value life insurance can be put in force with a mechanism to increase the death benefit. This is true for both whole life insurance and universal life insurance. And when that happens, that changes the calculation for the necessary premium to make the policy paid up.
Right.
Which means we do have the ability, we've set the stage for the possibility that we can continue to put money into the policy beyond just year 7, even if we've been paying what is practically the maximum amount that can go into the policy for years 1 through 7.
Right.
But there's some other things that we need to be aware of. The chief one is that the test, the 7-pay test, is applied retroactively, which is to say that we could pay that maximum amount for years 1 through 7. We might even decide, hey, what if we were to reduce the death benefit at some point to further reduce costs of the insurance piece of this to try and maximize the cash value growth. And let's say that we start this policy and we fund up to the maximum for 5 years. And then something happens and we decide, oh, you know what? We're not going to put money into this thing anymore. Maybe we should just reduce the death benefit now so that we don't have these additional insurance expenses that we don't want to pay for. Problem, if we do that, even though moving forward, we're not going to be making premium payments that would otherwise violate the modified endowment contract, a reduction to the death benefit that takes place during that 7-year period would apply now to all the premiums that were paid up to the beginning of the 7-year period. And if the new death benefit is less, or excuse me, if the allowable premium is less than the new death benefit that we have reduced to, we will at that point, violate the MEC test.
Sounds scary.
Scary and confusing. Let's use numbers as an example. Let's say you buy a policy, MEC allowable premium is $10,000 a year.
Mm-hmm.
You pay premiums years 1 through 5. Year 6, you want to reduce the death benefit. But if you reduce the death benefit, now the MEC allowable premium will be $6,000.
Yep.
Because you paid $10,000 years 1, 2, 3, 4, and 5.
You're already in violation.
You cannot reduce the death benefit without creating a modified endowment contract.
Right.
Now, here's the additional tricky part and why I waited so long to say this. We already covered that the death benefit can change over time. And if the death benefit changes, that can reset that 7-year MEC clock. If we are in year 8 and the death benefit increases on the policy, the MEC clock resets. We now have another 7 years of needing to be in MEC compliance. If we pay this premium, let's say it's $10,000 for years 1, 2, 3, 4, 5, 6, 7, and 8. But in year 9, we decide we want to make a reduction to the death benefit. Well, we again have to worry about violating the MEC test based on that one premium payment that we made in year 8. Because if we reduce it and the resulting death benefit now has a lower MEC premium than the $10,000 premium payment we made, we will, at that point, violate the modified endowment contract.
Right.
All of this sounds scary, but here's the really, really, really
I was going to say
news.
there's a host of other things you could do to a policy that restart that clock. As well.
Yes, there are.
Any material change.
Correct.
As the insurance industry likes to call it.
And if you look up material change in the IRS tax code, you won't find a list.
Right.
But what we can tell you is there are certain things that we've all agreed are examples of material change. Increases in death benefit are one of the biggest examples. Adding any kind of rider additionally would be an example. So if 10 years later you decide, hey, I'd like to have the waiver of premium rider on this policy, and the insurance company agrees to do that, you've affected a material change.
Right.
So
that's a funny example.
It's a funny example for me, but all of this sounds crazy and complicated, and a lot of people get really spun up in terms of trying to learn the rules and know them so they don't screw up. But the good news is you don't have to do that.
I'll say we can assuage your fears.
Yes, knowing the rules is really important for people like Brantley and I, because we are going to design life insurance policies around those rules.
Yeah.
But you knowing those rules as somebody who's buying life insurance is really insignificant.
Yeah.
Because at the end of the day, the insurance company is going to track all of this for you.
Yes.
And I assure you, they're going to track all of this for you. So when your policy is in force, the insurance company is going to constantly ensure that it's compliant for the MEC test.
Mm-hmm.
They do that chiefly by testing the policy every time they receive a premium payment from you.
Right.
And I do mean every time.
Mm-hmm.
So if you pay your premium annually, they're going to test it annually. If you pay your premium monthly, they're going to test it monthly. It does not matter if it's whole life insurance or universal life insurance.
Yep.
Universal life insurance can get a little crazy in terms of the accounting because payments can come in all the time in different amounts.
Right.
But they still do it.
I was about to say, I can assure you they do it.
We have firsthand experience on this.
Yeah.
Because we've had a few people go over the line and cross the MEC threshold and then get a letter from the insurance company saying you might have made a mistake and just so you know, like sign this and send it back to us and we'll send you back the excess money that you paid us that we shouldn't have. Otherwise, you're going to have a modified endowment contract on your hands.
Yep.
And every time they signed the paper and got the money back.
Yep.
We've even seen some situations with companies just sending some money back to people to say, hey, we received this check, but we really cannot put it into the policy.
Yep.
If you want to, you got to fill this form out and then send it back to us. But it creates.
They all have a slightly different procedure, but the same.
They do.
With the same result, which is you're not going to accidentally create a modified contract.
Which is a very good point to bring up because there's way too much. I'm not an agent, but I play one on the internet that comes up from people who are telling the unsuspecting public that, you know, you got to keep track of this because you could make a mistake and find out 5 years later when you go to take a loan against your policy that, oh, you have a MEC and now you got to pay taxes on these distributions. That does not happen.
I've never seen it happen. I mean, we've seen some people that had way older policies that had modified endowment contracts that the details are fuzzy.
Yeah.
As to whether I'm guessing they were told about 15 times that this was going to happen, but they didn't know what they were reading. So they just set it aside.
Right. And almost every time it's somebody who bought a single premium life insurance policy.
Yes. Yeah.
And those come with disclosures at issue. Like, in order to take delivery of the policy, there is a form in there that says this is a modified endowment contract. Sign here.
Now, let's talk about that context. Unless you got some other things you want to say, are they always bad?
They're not. Before we do that, there's one other thing I want to bring up, if you don't mind.
Oh, I don't mind.
And that is the fact that there's one situation in all of this discussion that is potentially a oops, I set myself up and now I accidentally I'm going to end up with a modified endowment contract and there's not much I can do to stop it.
Mm-hmm.
So it is possible in certain situations with certain term riders that are added to cash value life insurance policies, much more commonly whole life insurance than universal life insurance.
Yep.
Where the term rider either has a definite date that it goes away, or it's a level term policy effectively that's attached to the whole life policy, and the premium is going to rise significantly once you get to the end of the level term period.
Yep.
And in those situations,
we got a message from someone that happened to recently.
Oh, we did.
The last several months, maybe. I'm sure it wasn't as recent as I remember it being, but
in those situations, it's possible to have a term death benefit that's going to go away, and by virtue of it going away, you will now drop below the threshold for the premiums that you have been paying, and you will have a modified endowment contract on your hands.
Right.
That retroactive application that we brought up.
Yep.
It's not every insurance product out there. It's not. There's a couple of companies that do it this way. But it's important to understand.
We've asked them about what's your stance on this?
And there really isn't one.
Yeah.
It's important to understand that if your specifically whole life insurance policy has a level term rider with a specific level term period, you need to be very, very careful about the planned premium that will go into the policy, especially leading up to the point that the term rider is either going to terminate or come out of its level guaranteed period.
Right.
Because you could cast the stone years in advance that will put you in a situation where you will, in fact, violate the MEC test and end up with a modified endowment contract unintentionally.
Yeah. My recollection of that message we got was that it was a situation where the level term period had expired or was about to.
Correct. Well, get on the soapbox for just a minute. There's a video that we released on YouTube about this very subject like a year ago.
10 years ago.
And this one's not quite that old. It's just about a year ago, where somebody wanted to fight with me about the way the tax code is written and whether or not this really happens this way. And it's like, okay, look, I'm speaking from experience here because we've had it come up a few times. And then, to your point, just a couple months ago, somebody showed up and said, hey, I got this policy and I've got this problem because the term rider is going to go away and the company's telling me that if that happens, it's going to violate the MEC test.
But to renew it is going to cost me
way more money than makes sense. More. Yes. Yep. Again, wasn't the first time validation. I'd been down this road before, but here it is yet again. Well, this is out there. It happens.
We validated it just by looking at it. Like, I don't know how that works, but
not going to name names.
Was asked, and yeah,
not going to name names. What I am going to tell you is that if you buy a whole life insurance company from the big name mutuals, this isn't a problem because none of them do it that way.
Right. To my knowledge, you and I have never sold a policy that had a whole life policy with a level term rider.
No, we have not. Okay. So you had asked me, like, if you have a MEC, what is there anything good that can come out of that?
Well, and even more than that, like you can intentionally do it and it not be bad.
You can. For the 5 or 10 people out there who are sitting on, $500,000 in CDs that they never intend to touch and they just want to leave it to their kids, you could buy a single premium life insurance policy and augment the value with death benefit and pass that on, and it works the same way regular life insurance would.
Yeah.
A little sad you didn't laugh at my 5 to 10 people
joke. Hey, there's more insurance wholesalers talking about this idea than there are people who have ever done it.
But it works. It works.
Yeah, and you will apply some factor of leverage.
Yeah,
to the money that you use.
Just understand that if you do it, the cash that is now in the MEC has a much different tax consequence to it.
Right. That's why, we have talked to people about it in the past, and our opinion is always, it's a fine thing to do as long as you understand what the tax implications are if you have to tap that money.
Mm-hmm.
Now, if you have no plans and it would just be like an emergency, break glass in case of emergency sort of situation.
Yep.
Because you've got tons of other money in other places that you're using. Typically, this is going to be someone who's already retired or in that stage of life and is looking at their assets and going, I've got this $500,000 I would like to leave to an organization or grandkids or whatever, that I never intend on spending in any way, shape, form, or fashion. It's earmarked. Well, in that case, don't know, depending on your health and a lot of other things. But for argument's sake, let's say you could turn the $500,000 into $750,000.
Mm-hmm.
Then that may be a good thing. Just recognize that if you ever have to tap the cash value, there's going to be a tax consequence.
Yep.
But you still retain all the income tax-free benefits of a life insurance death benefit. So.
Yep, you do.
This used to be wildly more popular.
It was.
There used to be single premium whole life insurance.
Yeah.
Now there's not so much.
Yeah, it got kind of expensive with lower interest rates. And then there's been some innovation that's allowed people to effectively create a single premium policy without it actually being a single premium policy, which it keeps intact all of the life insurance benefits from a taxable standpoint. So people have tended towards that option more so. It was popular at one time. It's not now because interest rates are considerably higher, but there was a trend for a little while. It was more than 15 years ago, where people were intentionally buying a MEC policy, just single premium, and surrendering it like 5 years later because it was beating what they were getting on a high yield interest or to high yield savings account.
Yeah, right.
Doesn't really work today, given what's happened with interest rates. It's just net after 10% penalty tax isn't quite as attractive as it once was, but it was something. It's also something that nonprofits have used from time to time because they don't pay taxes.
Right.
So the tax liability to MEC distributions isn't the same in their world. That being said, I'll remind everybody that if the MEC doesn't have a gain, distributions are still not taxable.
Right.
So another application where they have come up here and there, though I think the world's gotten wildly more sophisticated at rooting this out. There was a time that people would use MECs as a financial aid planning thing for college.
Mm-hmm.
So because life insurance contracts generally weren't counted, they would take money, put it in a MEC, and basically start taking withdrawals from the MEC after kid enrolls in college to pay for things with the intention that they basically just surrender it as it broke even and not have any tax liability to it. So that's not as common as it once was, but it was something people did at one time. I would say for people who hold a MEC that they're not really intending death benefit features out of, probably the best application and thought process is that cash accumulates very similarly as an annuity would. And there are opportunities to use that cash for income creation, either by annuitizing the contract if you have that option, which is common on whole life insurance, not so common on universal life policies, or a 1035 exchange to an annuity product for the income feature.
Right.
And if it's something like a SPIA, because the cost basis transfers with the 1035 exchange, you can use the exclusion ratio to make part of your income ordinary income and part of it recovery of basis.
Right.
So if you have a MEC, there are some options that you have, just not as many as would be the case with a life insurance policy.
Those last few options you mentioned, I'm sort of smiling over here, which you can't pick up on a podcast, but those are things that technically work. I've been doing this for 25 years. I've never seen anyone do any of those, but.
Well, yeah. Yep. And to be totally honest, the number of modified endowment contracts I have run into
I could count
in nearly 20 years, it's not many.
Yeah.
The majority of them were more final expense style sales.
Yeah.
Where oftentimes somebody owned a small whole life policy they bought decades prior with like a $15 a month premium payment.
Mm-hmm.
And there was a single premium product out there that they could 1035 exchange into that would give them the same, maybe a little bit more death benefit, and they could stop paying the premium.
Yeah.
They were all by virtue of what they were, MECs.
Yeah.
But people
it didn't matter because
care.
there was no cash.
Right.
I shouldn't say there was no cash, but there was small dollars.
It was always death benefit earmarked for burial and stuff like that.
No one was planning on tapping the cash value.
Right. It's not common at all. I'm not saying they don't exist, but it's not common for us to run into people who have $1 million death benefit MECs with hundreds of thousands of dollars in them.
Nope.
It's not generally what happens.
No. Because, like, to go back to your earlier point, it doesn't happen without you knowing. So,
correct.
Typically, people will, when they get a letter from the insurance company that says, you sent us some money. We're not sure that this is what you intended to do.
And nobody, I'm not saying it's never existed, but nobody that has come to us has ever said, I got this weird policy that says something about, I don't know, endowment modified something.
Right.
That's never happened. We've definitely had some people reach out to us and say, why'd the insurance company send me my money back?
Yeah.
Be our clients or someone else. And that was the answer, because you violated the MEC test and they're trying to help you out. That's what's going on.
Yeah.
But,
because they have time. I mean, the rules allow.
Oh, yes, we should really quickly. 60 days after the close of the anniversary date for the year you did the violation. Right. So if you go past the amount,
but they won't wait that long. The insurance company will notify
right.
you immediately.
Yes, they will. They will. You just have
in our experience. I don't know what every company's policy is out there. But
yep.
In our experience, they'll let you know immediately.
That's correct. And I think that's everything that needs to be said about modified endowment contracts.
All right.
So
once and for all.
Educated, enthralled, and wishing it could go on longer, I know. But sadly, it has to end at some point, and that's right now. So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.